Hello, everyone, and thank you for joining us at our next presentation. Um, we have Natalie Pace joining us, and she is in the room, so we'll have an on-time start. If you have any questions, feel free to drop them in the chat. And again, we will be starting on time. Hello, everyone. I see we have more people joining the group. We do have our speaker in the room, and she is ready for her presentation. So we will have a on-time start at 12:25. If you have any questions, be sure to drop them in the chat, and we'll get to them at the end of the presentation. Okay, Hello, everyone, and welcome to the next presentation for the Investing in Alternative Traders Expo. Today, we have Natalie Pace joining us. Natalie Pace is the co-creator of, uh, she's the co-creator of the Earth Gratitude Project and the author of the Amazon bestsellers, The Power of 8 Billion, It's Up to Us, The ABCs of Money, 6th edition, and more. She's been ranked as a #1 stock picker above over 835 A-list pundits by independent tracking agencies and the tip traders. Miss Pace, Miss Pace's easy as pie chart nest egg strategies are enthusiastically recommended by Nobel Prize winning economist Gary S. Becker, former TD Ameritrade chairman and CEO Joe Maglia, and over 120,000 people who have transformed their lives and relationships with investing and money as a result of attending her retreats and reading her books. Ladies and gentlemen, without further ado, Miss Natalie Pace. Natalie, the floor is yours.
Thank you so much. And I'm so glad to be here at your Alternative Investing Expo. Let's jump right in. So there are risks, there are rewards, and there is actually a den of thieves, and you want to be aware of all of them. Crypto is plunging. Private credit funds have gated withdrawals. There is a deepfake Buffett video circulating, encouraging people to do certain alternative investments to earn income. And there are ultra high yield offers in alternative investments on YouTube and email. Which one of these should you really be jumping into? And I think we should start by saying that silver and Peru, which is a copper play, were the superstars of 2025, followed by gold, the Magnificent Seven, and clean energy. Now, I wouldn't recommend alternative investments in clean energy because the industry is volatile and there's a great deal of competition from China. So it is more difficult for us to get it right by even investing in an individual company that is publicly traded could be problematic. But certainly when you're going into private equity or private credit, it really becomes problematic. So we suggest perhaps like an iShares Clean Energy ETF, if that's of interest to you. It's just going to be a little bit safer than the alternative route. We're going to talk more about silver, Peru, and gold first because their performance is way down from the 2025 all-time high. So Bitcoin and silver are down by half, gold is down by 26%. And the question is, what's going to recover, right? So should you be jumping in and buying low, or is it buying low with gold and silver? It certainly is buying pretty low with Bitcoin, but we certainly have seen it go lower as well. So I'll give you the cliff notes on it. Gold and silver are both expected to recover from this kind of a period of weakness. There are some variables that could prevent that from happening. We'll talk about those. Crypto, however, I think that, and this has been spot on through, it's a pretty strong trend. So Bitcoin is highly correlated with its halving events. The next halving event isn't until April of 2028. That number isn't a stock solid number. It moves around a little bit. But what we have seen is that the last one was in 2024. I named Bitcoin the investment of the year. It really, went on fire between 2024 and 2025. And then when we named it in 2024, we also said, look, in 2025, it should hit its high, but then it could start hitting a crypto winter. And so, one of the things that's really important for alternative investments is to have it as a part of an overall wealth strategy for your paper assets, your liquid assets. I consider real estate and all of that, especially if you own your own home or your own income property, the business you own, these are all assets, part of your wealth. But when we talk about liquid assets, they are or our nest egg strategy or wealth plan strategy. That's what I'm talking about. Checking, savings, brokerage accounts, and then alternative investments should be included in there as well. You might consider it as a hot slice. You might be thinking of it as safe, and it's not that safe. But that's what helps us is that you don't just jump all into crypto or gold or silver. You see that they are more volatile than you might have been told. And these are assets, and almost all of the alternative investing assets do have aggressive email, social media, advertisements to entice you in, right? And they'll try to, if they already know, because they know what kind of customer you are, that's, the world we live in. If they already know that you're going to be highly motivated by fear, they'll try to scare you and then say the only thing good that you could possibly do is either Bitcoin that's going to hit 1 million or gold that's going to hit 15,000, etc. But it does swirl around a bit, and that's what helps us, right? So if you have and I'm going to be showing our pie chart, if you have it in a hot slice and your hot slice doubles or triples, so silver doubled last year, you now have two hot slices. You can sell one and keep it, keep that money. And that way, if the slice that your original investment goes down, you can actually buy more low if you think it's going back up, right? If you think it's still hot. Now with crypto, the cliff note on that is that we did indeed, it's way down from the October 2025 high, down by half. It could go lower. And the reason for that is that we see that the crypto winters can be 18 to 24 months, and that the recovery typically starts a little bit before the next halving event. So that would mean that maybe between now and a year from now, that crypto could be still in that crypto winter. That's if it follows the halving event, which has been very, very reliable correlation. So what's going to happen with gold or silver? And as I just said, rebalancing is key. Capture gains at least once a year. And we always encourage people to do their rebalancing at the end of the spring rally, at the end of the Santa rally. So maybe early May, early January is a good idea to do this. And if you had done this, you would be capturing gold and silver very close to their all-time highs. And again, keeping that money instead of going up and going back down, etc. Very key, and I'll show you what the pie chart looks like. So this is for a 30-year-old who's overweighting safe because they're concerned about the risks in the economy. And again, if you have a hot slice or two of silver and you end up with, double the amount, you can sell the gains and keep your original investment, which would allow you to buy low now instead of, okay, now I don't have my gains anymore. So this is the performance by sector, including a lot of alternatives. And the reason that I put this in here for the 1 year is that silver is still looking great, right? But the Magnificent Seven looks great as well. So that's kind of why we want to make sure that we also have other things. Large growth is where our Magnificent Seven is highly concentrated. So if you have a conservative portfolio, and just alternative investments that you think are safe and earning you income, you're missing out on the biggest drivers of growth that there are, right? So you want to have, and we're using value replacement funds. I'll tell you why that is the case in just a few minutes. All right, so here's the year-to-date performance and here's the 1 year performance. And what you might notice here is that obviously crypto is at the bottom. Over the year-to-date performance, silver has been and gold have been negative, while the S&P is up about 9.3%. But 5 out of 7 of the Magnificent Seven are lagging behind the S&P 500 with 3 losers in the bunch. And so again, we talked about, why Bitcoin is down because we're expecting the crypto winter. But what happens with gold and silver, and it's kind of similar with the Magnificent Seven, excluding Tesla. Tesla has other issues and challenges, kind of associated with what I told you about clean energy. Very strong Chinese competition pushes down the prices. So just as a quick example, Tesla made $15 billion a couple of years ago in net profit. It was under $5 billion in 2025. So it does face some very severe competition because even though it tries to position itself as, an AI leader or robotics, for right now, it is a car company. That is where the majority of the profits are made. So what happens though with the other 6 out of 7 of the Magnificent Seven, which also has to do with gold and silver, is just profit taking. So when things hit their all-time high, the whales of Wall Street want to lock in those gains because they know that the people that are buying high are probably the retail investors, right? So they can lock in the gains, they can bring it back down, they can buy more low. And, again, it's very easy to be on the wrong side of the trade if you're just reading those social media posts or emails or even headlines. Oh, gold hit an all-time high, silver's going crazy. And then you buy. And the whales are like, yeah, I'm going to take some profits now. Same thing with AI, and which is what the Magnificent Seven has, a lot of their holdings are very rich in AI as well. So here are the gold and silver price targets, and they are a pretty strong recovery. If silver hits $100 again, that could be really strong, right? So it could give you greater confidence to keep those hot slices of gold or in silver because the recovery is expected to happen. What could stave that off is rising interest rates, because then maybe the investors are going to be lured over to bonds where they can get more income. Also, debt concerns, which are very concerning, if those start making headlines, that could push people over to the precious metals. We talked about crypto winter, so I'm not going to do that again. So, what happens with precious metals is that if for any reason stocks go down, in the first phase, the precious metals usually drop as well. Not as much, however. And then there comes a point if stocks keep going down where people get absolutely disgusted with their losses and they say, I want precious metals, and they just jump in, and that tends to go high. Also, debt concerns. So, the most recent high was obviously in 2025, but the prior cycle was 2011. And I think this is kind of important to realize both why it did the high in 2011, but then what happened between 2011 and the pandemic. So 2011 was the high, and that's when the S&P 500 actually downgraded the US from AAA to AA plus. Debt concerns, right? And then after it hit the high, then it really plunged and it went down about 40%, and it stayed there until the pandemic. So again, those ads that are telling us that gold never goes down, silver, went down and it stayed there even longer than gold did. So it does have volatility in there. After the 1980 highs for gold, gold dropped at really low from 800 to the 350 range. It stayed there for a quarter of a century. So it's important to be understanding, again, if you're using the hot slice strategy, it's going to keep you closer to the right side of the trade, because when you get a lot of gains, it's going to say capture them. When it goes down, instead of selling low because you're disgusted, it's going to say, if you think it's going to be hot, buy low. And again, there are trends that will push it either way. So be sure that you have performance in your plan. Be sure that you have a rebalancing strategy. And if you don't already have silver or gold, I wouldn't do Bitcoin yet. I think it's too early. Then you could consider a hot slice. The question is coins or ETFs. I also would consider dollar cost averaging into it rather than just buying a full hot slice. Because even though it is down 50, by half on silver, by a quarter on gold, it's still pretty high on the trajectory. Dollar cost average maybe over a year. So if you have, 25,000 in that slice and you want to dollar cost average, maybe you do $5,000 every 4 months, if that makes sense, until you have your 15. So coins or ETFs. The thing about gold and silver is that A, it doesn't earn income, and that's why when bonds, the income on bonds goes up, people are more attracted to them. But B, if you own the coins and you do try to capture gains, then you're going to pay capital gains taxes. But if you buy, let's say, gold or silver miners in an ETF within your tax protected retirement account, there are no capital gains. And some of the online discount brokerages, you can actually buy and sell it with no trading fees. So I think it's important to start thinking about, that's the way really wealthy people think, is try to get all of their money, all of their investments in tax protected retirement accounts so that the gains are not subject to capital gains taxes. So that's what I would say is that you could buy like an SLV or a GLD in your retirement account, and then that helps. Because I do know people when I was, have a lot of private clients, and they were rebalancing at the end of the year and silver was still really high. And I said, why aren't you capturing gains? Because they mostly had silver coins and they were worried about the capital gains taxes. And I said, a lot of times it's better to go ahead and sell high and pay your capital gains than it is to just ride the roller coaster. And they would have made a lot more money than the amount that they've lost if they had done that. So I'm a bigger fan of tax-free and, protecting your capital gains. So it's important to remember that alternative investments are volatile. They have aggressive and very cheap email and social media ad campaigns. So that capture gains, diversify, and rebalancing mindset, very, very key. And again, this is that sample pie chart. You can mock up your own personalized sample pie chart. You just have to put in a couple of quick data points on our free web app. If you email info@nataliepace.com, we're happy to send you that information. So again, info@nataliepace.com. Now, private credit funds can gate withdrawals, they can be illiquid, they can have junk bonds, and they can have paper losses. That's all in the fine print. Sometimes the salesman isn't properly revealing all of the fine print, but it is the fine print that is enforceable. So if you buy into something and you don't know that you can't get your money out easily, or you've kind of agreed to it, but you didn't realize that you couldn't actually get your money out, like some of these private credit funds, they gated the withdrawals, so you can't get it out. Others, they haven't gated withdrawals, but only 10% is allowed in a 1 year period. So it's really very tricky because if they start to get into trouble, and obviously if you're an investor, you probably have heard that they have gotten into trouble. It's a very distressed industry, kind of because of those junk bonds that they can invest in. When you hear about it and you kind of say, well, you know what, I'm not comfortable with that anymore. I want my money back. And they say, sorry, illiquid, or we just gated the withdrawals. So I think that you should be very cautious of it. You absolutely have to read the fine print. Now, private equity LLCs are, these are also a problem because they also will use high interest and also high interest to bait you in. What do I mean by saying that twice? High interest rates, they'll say, hey, we're going to give you 9 to 13% interest on, on your investment or on your loan to us. And then they'll also say, and it's in oil and gas, which, as you know, is at an all-time high. Or they'll say, and it's in real estate, and they'll try to say, everybody's doing a storage unit. So just be very cautious because it's easy to make a YouTube ad asking you for money. It's really hard to run a business. And in fact, oil companies are not easy to run unless you're the big ones, right? So be very cautious about both private equity funds, which can be more of an equity investment in junk bonds, and private equity LLCs, where they say that you actually own the storage unit, but you don't. You own equity in the company that owns the storage units, or you own equity in the oil and gas company. So you have to ask yourself, can that person run the company? And what we've seen, and there's one particular one I'm thinking about, which I can't tell you what it is because this particular CEO is very litigious. Anytime anybody mentions his name and certainly mentions that he's associated with a felony, he sues them. So that's his strategies. A lot of the money that you're loaning them is not necessarily going to run the business, but multiple lawsuits. So there's one I'm thinking about. It offers 9 to 13% interest. I recently saw it on YouTube. It is a family-owned business. They do not have experience running oil and gas companies. They have experience the principal investors, not the people who run the company, they have experience in non-C-suite roles. And the CEO, he has a bit of a dodgy past, including a felony conviction and multiple lawsuits and challenges, etc., that I would be concerned about. The other thing is payments are in kind. So you loan them money. They say that you own a bond. But instead of making interest in cash to you, they say, why don't you let us just pool that and give you more bonds? And so in this particular company, that's happening with 50%. So they aren't actually having to pay any money out at this point. That's important too. Again, this is all financial engineering. It's not necessarily running a business. So 107 oil and gas bankruptcies in 2020, 142 in 2016. Clearly, this is a difficult industry, especially if the prices go back to where they were, which is $65, $70 a barrel. That means that we got to get stability in the Middle East. And you might think that high oil and gas prices are great for oil and gas companies, but in fact, they are not. Because if the consumer is spending too much at the gas pump, they stop spending elsewhere. And that's when a recession is highly correlated with high oil and gas prices. And that means that everybody stops traveling and the oil and gas prices can plunge. We saw a negative. So, people were paying not to take oil deliveries during the pandemic. So I just would be very cautious of being baited in. I think what you should realize is that the higher the interest that's being offered, the higher the risk. And grade your guru before you listen to anything that he or she says. On the Deepfake Warren Buffett video, real estate and dividend stocks were recommended for the income. Is this something Buffett really said? And it's not. He said in a recent, just 2 months ago, CNBC interview with Becky Quick, he said that stock prices are silly and sometimes you do nothing. And in fact, most of Berkshire Hathaway's investments are right now in short-term treasury bills. So I think a couple of things I wanted to show you. These are blogs. So they trusted him. Now he doesn't return calls. This is a couple that invested in private real estate REITs, a private equity offering, and they were told it was safe and that they were going to earn a great income, which was like I think 9%, which was unbelievable at the time. This was when interest rates were zero. And that they would own real estate. Of course, they didn't own the real estate. They owned stock in the company that owned the real estate. And that company had been cash negative for 5 years. They didn't do their due diligence on that. It is harder to find due diligence on private equity because it's not publicly traded. And when they asked for their money back, they lost $18,000. So I do think it's important to read that one. And if you go to my YouTube channel, I'm Natalie Pace on YouTube and Substack. I'm going to have links to this in my most recent video conference. So you can access it there, or you can actually email info@nataliepace.com. But I do take all of these subjects deeper. So I have the higher the dividend, the higher the risk. This is my most recent blog, also about Warren Buffett's investing tips and that deepfake video. And one other one here, which we'll talk about if I have time before questions, about our margin trading problem. So back to the PowerPoint. 4% income on 1 million is $40,000 annually. So it's great. We definitely want income, but we're using value replacement funds rather than dividend stocks in the United States because the US tends to pay a lower interest on the dividend stocks and they have much higher debt and leverage. If you get like in a Ford bond, 4.5% dividend, also Ford is still rated junk by Moody's. It has a lowest rung of investment grade with a negative outlook by S&P 500 and Fitch. So it's, again, adhering to that higher dividend, higher risk. We actually were saying, hey, why not Peru? Why not Australia or Indonesia or Ireland? And you're making as good or sometimes even double the income with a lower risk in terms of Africa because it's a AAA rated country. And then Peru doubled. So we've seen great results by using value replacements for our value replacement funds. So important mantras for your alternative investments: never reach for yield. The higher the dividend, the higher the risk. And I'm more concerned with the return of my money than the return on my money, right? Like, are you going to get your money back? That's a question you should ask before you even think about any of this stuff. Read the fine print as well and really understand the terms you're agreeing to. So our fixed income strategies are keep the term short, keep the credit worthiness high, lean into newer companies, underweight older companies, observe the insurance levels and know the fine print and risks. So again, gold and, can be a good performer when things go south, as can silver. And you should still have stock investments. I mean, look at this. If you earn a 23% annualized return, which is what the S&P 500 did since 2023, it'll only take you 3 years to double your money. So again, a diversified plan is going to be really key. Wall Street has a gambling problem. Margin trading can really snowball. It adds volatility and it's at an all-time high. So I do encourage you to read that blog. We can't jump into it too deeply because I do want to take a few questions. And again, if you do want to personalize your own pie chart, just email info@nataliepace.com. If you want these charts about our asset bubbles or, the CAPE ratio, where stocks are pretty high, and this is highly correlated with recessions too. That's why our sample pie charts were overweighting safe. And then finally, I just want to say that we teach our pie chart strategy at the Financial Freedom Retreat. We focus one full day on what's safe and how to earn an income without paper losses. If you register for the fall retreat by July 31st, you're going to get the best price. So you want to do that now. Email info@nataliepace.com. Also, I am going to have a bonds and fixed income without paper losses masterclass the following Saturday. You must attend the retreat in order to be able to come to the masterclass, because the information that you'll learn at the retreat is the foundation you'll need to understand what was going on at the masterclass. So again, email info@nataliepace.com. Check out those blogs. We're happy to send you links to the blogs or links to the personalized web apps that you can use. And of course, if you'd like more information about the retreat or the masterclass, email info@nataliepace.com. Also, you can get information on them on the homepage. So if you go to nataliepace.com, on the homepage, you'll see a link to the retreat flyer. And in the menu, you can actually easily locate the bond masterclass information as well. All right, I'll take questions if we have any.
Perfect. Yes, we have a question. Someone asked, with AI generated content and deepfakes becoming more convincing, how can investors verify information before making a decision?
Yeah, and I would say, well, first of all, if you're seeing something on social media or by email, my first thing would be, I think this might be a fake. And why is that? We already know that these social media companies know that even up to 10% steadily is an outright scam on their social platforms. We've seen studies that show this. If you're seeing it, and you are afraid of things or whatever, they're targeting you. So I would say the best strategy is to consider that it's probably a fake. So how do you grade your guru, right? Like, I mean, Warren Buffett rarely, does interviews. And when he does, it's usually just CNBC with Becky Quick. So if it's not a CNBC video, Warren Buffett probably didn't do it. Also, AI is pretty good at identifying these. So you could just ask, you could just say, hey, I just saw this video of blah de blah person saying XYZ. Is this a deep fake? Is this real? Chances are AI will get that one right. They don't get everything right, but they are pretty good on the scams. Okay, anybody else?
I have another question. How much of an investment portfolio do you think is reasonable to allocate to crypto, and what factors should influence that decision?
Yeah, so I think that where you're going to start is with our sample pie chart, right? So the personalize your own sample pie chart, and it's going to vary by age. So, if you go back to my PowerPoint presentation, you're going to see that the person that is older is going to have a lot more safe and less in crypto. So I think that crypto should be at most four hot slices, right? And it's going to be based on your age and then whether or not you're overweighting safe. So the person that is 30, you might have seen that one, that person gets a lot thicker slices. Hang on. There it is. And this, if they weren't overweighting safe, it would be even more of their portfolio. So the percentage is going to be decided on your age and whether or not you're overweighting safe. Okay. And again, it's very volatile because in addition to crypto being, very much adhering to that correlation with the halving events, it is also associated with stocks going down. When stocks go down, crypto tends to go down. So that is different than gold and silver. When stocks go down, they tend to remain, they will get dragged down, but they remain more buoyant and then they tend to go higher. And that may have a lot to do with margin trading. It may have to do with, the people that are gambling on crypto. If they start losing assets in other ways, they have to sell their crypto. So that sort of thing. But I think one other thing I want to remind you about crypto is that you can now actually purchase Bitcoin and Ethereum ETFs within your tax protected retirement account. I think that's another thing to consider because you couldn't do that, 4 or 5 years ago. You can do it now. And so crypto is another thing where you're paying high capital gains unless you get it tax protected. That might be it for us. Thank you, guys.
Absolutely. I think we have time. We have one more question.
Oh,
Someone
okay.
asked, would you buy any new IPO stocks?
Ooh, I think it's really a dangerous, right? And the reason for that is that we're seeing a lot of insider liquidity events for the IPOs. So, I would be, if you're Warren Buffett and you really know how to pick stocks and you know that you're buying to a great company that's going to be great for 25 years and you're buying it at a low price, that's one thing. So I'm not saying that everybody should never do this, but if you don't really understand how to evaluate stocks and whether or not you're purchasing it for a good price, then you should realize that you might be playing with tennis with Serena Williams and she can zing them right past your head and, take profits on your loss. Um, so in general, I would say probably not a good idea. And in fact, in my pie chart strategy, I don't even recommend individual stocks that are publicly traded. I think that if you want to, it doesn't mean you can't invest in them, but think of them more as Vegas money because they require all of that analysis and there's a buyer and there's a seller, right? And that if the other person not only has a team of analysts and a bunch of different trading platforms and can even step in front of you on the trade, right, legally, they have a lot of advantages over you that you may not be considering. So I would say in general, no, but not for everybody. Some people are good at stock picking. And if you want to try it with your Vegas money, okay, but still do your due diligence.
Perfect. That is all the time that we have today, so definitely appreciate you in answering that extra question. If you all need to ask any additional questions, feel free to reach out to Ms. Pace directly. Otherwise, we still have presentations for our Investing in Alternatives Summit, so make sure that you stay tuned for our next presentation. Ms. Pace, thank you for your time, and we look forward to seeing you at some of our future events.
Thank you so much. You guys have a great weekend.